All right, let's jump straight into this explainer. We're tackling one of the most absolutely vital but honestly kind of tricky accounting standards out there, IAS 33, earnings per share. Look, if you're analyzing a company's performance, pretty much everything boils down to this single metric. Get it wrong, and you might think you're buying a massive growth machine when you're actually holding a shrinking asset. So today we are going to completely demystify it. We're going to build a master formula that you can confidently apply to literally any scenario you run into in the real world. Here is how we're breaking it down today. Section 1, the basic EPS formula. Section 2, adjusting for bonus issues. Section 3 covers right issues and TERP. Section 4 is unpacking diluted EPS, and we'll wrap up with Section 5, convertibles, options, and warrants. Let's get right to it. Section 1, the basic EPS formula. So let's start right at the foundation. Before we get into all the crazy corporate actions, we really just need to know exactly what slice of the profit pie each ordinary shareholder is getting today. This metric is your absolute financial baseline. Think of it like owning a pizza shop with a few friends. Basic EPS is just a strict look at reality. It tells you, in no uncertain terms, exactly how much of today's cash is available to the standard equity holders right now, based purely on the shares or slices of the pizza that actually exist today. Which brings us to the master formula. Now, for the numerator, we can't just grab any profit number. We only want profit after tax, and, this is crucial, after we've paid out any equity preference dividends. Why? Well, preference shareholders are basically the VIPs, right? They get their cut first. We have to honor that commitment. Then, whatever is left over gets divided by our denominator, the weighted average number of ordinary shares outstanding during that period. Bam, that gives us our baseline EPS. Moving on to Section 2, adjusting for bonus issues. Okay, so what happens to our denominator when a company seemingly creates new shares out of thin air? This is where our basic formula gets its first real stress test, because we have to differentiate between how those shares are actually issued. If a company issues shares at full market price, well, that brings in fresh, hard cash to generate more profit. In that case, we simply time weight those shares from the day they're issued. But a bonus issue? Totally different beast. Absolutely no new cash comes in. The company is just capitalizing its reserves. It's literally just slicing the exact same profit pie into smaller, more numerous pieces without making the pie itself any bigger. Because of that, to keep our year-over-year comparisons honest, so investors aren't completely faked out by an artificial jump in the share count, we have to adjust our historical shares as if these bonus shares always existed. We do this using the bonus factor, which is super simple. It's just 1 plus the bonus ratio. So, say a company issues 1 bonus share for every 2 existing shares. That's a 1-to-2 ratio. Your bonus factor is just 1 plus 1/2, or 1.5. You literally just take that factor, multiply it against all the ordinary shares outstanding before the bonus issue, and it perfectly smooths out the historical record. Next up, Section 3, right issues and TRP. Now we're stepping into slightly trickier territory, the right issue. This is where a company offers shares to its existing shareholders at a discount compared to the current market value. Because these shares are sold at a discount, we actually have to artificially split them into 2 conceptual chunks in our brains to keep our master formula balanced. One chunk represents shares fully paid at market value, bringing in fresh cash, and the other chunk represents completely free bonus shares that just dilute the pool. So to figure out exactly how much of a bonus factor is baked into that discount, we use a slightly intimidating acronym, TERP, or Theoretical Ex-Rights Price. Now don't let the name scare you. Think of TERP simply as the new average share price after that discounted cash actually hits the bank. You just calculate the total value before the rights, add the proceeds from the rights, and divide the whole thing by the total new number of shares. Once you have TERP, finding the right issue bonus factor is a total breeze. You just divide the fair value of the shares before the right issue by the TERP. Then you apply that factor to your historical shares exactly like we did with a standard bonus issue. Section 4, unpacking diluted EPS. All right, we've totally mastered the present reality, so now it's time to grab our crystal ball and look at future potential. You know that companies often issue financial instruments that aren't shares today, but they have the potential to morph into ordinary shares tomorrow. If a company has these lurking around, we owe it to investors to show them the worst-case scenario. We have to answer a highly cautious question. How tiny could your slice of the profit pie realistically get if literally everyone exercises their rights? But hey, before we calculate a single thing, we need to establish the absolute golden rule of IAS 33, and this is straight from the source material. Diluted EPS can never, ever be higher than basic EPS, period. It's fundamentally a warning metric. The material emphatically points out you can forget your own name, but do not forget this rule. If your math ever spits out a higher diluted EPS, it means the instrument is anti-dilutive, and you must completely ignore it. You never, ever use diluted EPS to paint a rosier picture of the company. Finally, Section 5, Convertibles, Options, and Warrants. Let's see how these specific culprits actually plug into our master formula. We really need to know exactly how to adjust our numerator and denominator for these hidden promises. We basically have two main categories of diluters: convertibles, like convertible bonds, and options or warrants. Now, notice the big contrast here. Convertibles affect both the top and bottom of our formula, adjusting the profit and the share count. Meanwhile, options and warrants, they only bloat the bottom denominator without adding a single cent to your profit numerator. Let's break down convertibles first. If bondholders trade their debt in for shares, we obviously add those new conversion shares to the denominator. Easy. But wait, if the debt is gone, we don't have to pay interest on it anymore, right? So our profit actually goes up. But, and this is a huge but, more profit means you owe the government more tax. So that interest savings added back to the numerator absolutely must be net of tax. It's a vital step that catches a lot of people off guard, but you need it for an accurate worst-case scenario. For options and warrants, the approach shifts. When these are exercised, the company does get a little bit of cash, but it's usually at a price way lower than market value. Just like the right issue earlier, we conceptually split this up. We completely ignore the cash we would receive for the fair value equivalent, and we only isolate the nil paid, or basically free shares. We add only those free shares to our denominator, keeping our profit numerator exactly the same. It's just a pure dilution play. Pulling this all together, this right here is your ultimate IAS 33 survival guide, cleanly stacked into one logical flow. You start with your base, profit after tax minus preference dividends, all over weighted shares. Then, you tweak your historical share count for bonus factors and right issues to keep everything comparable. Next, to find that diluted figure, you layer on those future no-paid shares and convertible adjustments. And finally, you run the ultimate sanity check, verifying your diluted EPS is less than or equal to your basic EPS. At the end of the day, wrapping your head around earnings per share isn't just some dry, academic accounting exercise. It is the critical lens through which we judge value. If a company's basic EPS looks amazing today, but their diluted EPS reveals that a massive wave of future shares is about to eat up your present value, well, you got to ask yourself, are you accurately pricing in that future dilution today? Keep that question front and center next time you're digging into a company's financials. Thanks for joining me on this explainer.